$69 billion evaporated in 6 hours. Oracle's stock collapsed 10% in a single day. The company that powers half the world's databases just lost more money than entire countries are worth. And the reason should terrify you, because it's exactly what I predicted 3 months ago when I told you the $500 billion AI bubble would burst between Q4 2025 and Q2 2026. Today is December 24th, 2025. The collapse didn't wait. It's happening right now. And the triggering event proves every prediction I made. The infrastructure debt just imploded, the technical failures are confirmed, and Wave 2 layoffs are about to hit your company. Let me show you what happened in the past 7 days and what you need to do in the next 90 days to survive. December 17th, 2025. Blue Owl Capital walks away from a $10 billion deal with Oracle to build a data center in Michigan. This isn't just another canceled project. Blue Owl is Oracle's biggest infrastructure partner. They funded Oracle's $15 billion facility in Texas. They backed the $18 billion campus in New Mexico. They used the same financing structure every time. Special purpose vehicles that own the data center and lease it back to Oracle, keeping the debt off Oracle's balance sheet. The same accounting trick Enron used before it collapsed. But this time, when Blue Owl looked at Oracle's numbers, they said no. The Financial Times reported that lenders pushed for stricter terms because of concerns about Oracle's debt and shifting market sentiment on AI infrastructure spending. Translation: the lenders finally did the math and realized the numbers don't work. Here's the math they saw. Oracle has $105 billion in debt at the end of November. That's up $78 billion from 1 year ago. KeyBank estimates Oracle needs to borrow $100 billion more just to complete their AI build-out. But Oracle's cloud revenue backlog, the $523 billion they keep citing to justify the spending, that's not cash. Those are contracts for future AI services that depend on technology that might not work. When Blue Owl walked away, the market understood what that meant. If Oracle, a 90-year-old enterprise software company with decades of stable revenue, can't secure financing for AI infrastructure, the entire AI boom is built on unstable foundations. Oracle stock dropped 10% that day. $69 billion gone. But it gets worse. Oracle is now down 40% from its September high. That's $260 billion in destroyed market value in 90 days. And Oracle isn't alone. CoreWeave, the AI infrastructure company that pivoted from crypto mining to ride the AI wave, is down 60% from its July peak. They have $3.7 billion in current debt, $10.3 billion in long-term debt, and $39.1 billion in future data center lease commitments. They're projecting $5 billion in revenue this year while claiming $56 billion in backlog. If even 10% of that backlog disappears because AI capabilities don't materialize, they can't service their debt. This is the debt collapse I warned you about. Not one company failing. An entire ecosystem discovering that AI can't generate the revenue needed to justify the infrastructure spending. And when the infrastructure spending stops, everything collapses. The chip makers lose their customers. NVIDIA, which makes up 7.3% of the S&P 500, loses its revenue. The stock market, which is now 35% concentrated in the top 5 tech companies, craters. But the debt collapse is only half the story. The technology is failing too. And we now have peer-reviewed proof. Researchers at Google DeepMind published a study in Nature documenting something called model collapse. When AI models train on AI-generated data instead of human-created content, they develop irreversible defects. The models forget reality. They hallucinate more. Their outputs become wrong and homogeneous. Think of it as AI inbreeding. Each generation gets worse. Here's why this destroys the entire AI business model. By April 2025, 74% of new web pages contained AI-generated text. That means every AI company scraping the internet for training data is now training on contaminated data. The models are eating their own output. And according to the research, this collapse is irreversible. Once a model degrades, even retraining on real data doesn't fix it. You need access to pre-2023 datasets, the bulk stores of human-created content from before AI pollution spread across the web. The companies know this. That's why OpenAI's chief financial officer admitted their role as a frontier AI maker depends on whether their chips last 3 years, 4 years, 5 years, or longer. They don't know. They're guessing. Industry experts say AI chips can train models for 18 to 24 months before they're obsolete. But the AI companies told investors the chips would last 10 years. They use 10-year depreciation schedules to justify hundreds of billions in spending. Michael Burry, the investor who predicted the 2008 housing crash, is now betting against NVIDIA. He's accusing the AI industry of accounting fraud. Burry says true end demand is ridiculously small and customers are funded by their dealers. He's talking about the circular financing. NVIDIA gives money to OpenAI so OpenAI can buy NVIDIA chips. NVIDIA reports it as revenue, but there's no real customer. It's just money moving in circles between companies that own pieces of each other. The S&P 500 is trading at a Shiller PE ratio of 40. That's the exact valuation we hit at the peak of the dot-com bubble before the 75% crash. Except the concentration risk is worse now. The top 5 companies are 35% of the index. In the dot-com era, it was 20%. When these companies collapse, they take everything with them. Let me connect this to your job, because this is where it gets personal. In my original video, I told you companies weren't firing people because AI works. They were firing people because AI failed and they needed to cover the losses. I gave you examples. Klarna cut 40% of their workforce and blamed AI, then admitted 0 layoffs were AI-driven. Salesforce fired 4,000 people claiming AI could do the work, then quietly rehired when the technology failed. IBM cut thousands for AI transformation, then started rehiring because the automation didn't deliver. Those were Wave 1 layoffs. Companies cutting workers to free up cash for AI investments. What's happening now is Wave 2. Companies cutting workers because the AI investments failed, and they need to survive the losses. This is fundamentally different. In Wave 1, you could tell yourself the layoffs were temporary, that AI would eventually create new jobs, that you just needed to learn the new skills. In Wave 2, the skills don't matter because the technology doesn't work. Your company spent 2 years telling you to learn AI. They spent millions on AI tools, consulting, and infrastructure. And now they're discovering what the MIT study found. 33% success rate. 2/3 of AI projects fail completely. The vendors oversold. The technology underdelivered. And your executives need to cut costs to cover the losses. Oracle just proved this. They spent $105 billion on AI infrastructure. Blue Owl walked away from another $10 billion. If Oracle can't secure financing, they can't complete the build-out. If they can't complete the build-out, they can't deliver on those $523 billion in cloud contracts. If they can't deliver, customers cancel. If customers cancel, Oracle defaults on $105 billion in debt. And if Oracle defaults, every lender in the market reprices AI infrastructure risk. When that happens, the financing dries up for everyone. CoreWeave can't roll over their debt. Smaller AI companies can't raise capital. The infrastructure boom stops. And when infrastructure spending stops, the layoffs cascade. Not just in tech. In every industry that bet on AI transformation. Here's your 90-day timeline. Right now, we're in the denial phase. Companies are calling Oracle's situation a one-off. They're saying their AI investments are different. They're not. By February, you'll start seeing AI project cancellations disguised as strategic pivots. By March, the layoff announcements begin. They won't call it AI failure. They'll call it restructuring, right-sizing, focus on core business. But the pattern will be obvious. Companies that spent the most on AI will cut the deepest. The companies that survive aren't the ones with the most AI implementation. They're the ones with the least AI debt. And the workers who survive aren't the ones with AI skills. They're the ones who do what AI provably cannot do. Physical presence, relationship building, judgment under uncertainty, creative problem solving when the data is incomplete or contradictory. These are the skills that matter when AI fails. This is why the AI Career Survival Kit doesn't teach you AI tools. It teaches you how to position yourself as essential when the AI tools fail. How to document what you do that can't be automated. How to make yourself visible to the decision makers who determine who stays and who goes. How to build the relationships that protect you when your company starts cutting costs. The Oracle collapse on December 17th was the trigger. Blue Owl walking away sent a signal to every lender. We don't believe AI can generate the returns needed to service this debt. That signal changes everything. The cheap financing stops. The infrastructure boom ends. The AI valuations collapse. And the companies that can't service their AI debt start failing. We're watching it happen in real time. Oracle down 40%, CoreWeave down 60%. The semiconductor sector selling off violently. The market is repricing the entire AI sector based on one simple realization. The revenue isn't materializing. The technology has fundamental limitations. The accounting was optimistic. And the debt is real. I told you this would happen between Q4 2025 and Q2 2026. It's December 24th. We're in the window. And the collapse is accelerating faster than I predicted. The infrastructure debt collapsed on December 17th. The model collapse research confirmed the technical failures. The lenders are walking away. The market is repricing. You have 90 days, not to learn AI skills, to position yourself for what happens when AI fails. Document what you do that can't be automated. Build relationships with decision makers. Make yourself visible. Cut personal expenses. Build your emergency fund. Update your resume with accomplishments, not AI tool proficiency. Network outside your company. And if you're in a company with massive AI debt, start looking now. Wave 2 is coming. The only question is whether you're ready.